Well, there are no great surprises from Mario Draghi, with the ECB keeping their benchmark interest rate unchanged. The ECB chief said he expected inflation to remain above 2% this year and that downside risks to the economy still remain. I'm joined by Sebastien Galy from Soc Gen, a familiar voice here on Dukascopy TV, to talk about the situation in the Eurozone and also to look ahead at the Bank of England meeting on Thursday. Sebastien, we weren't expecting any change from the ECB. Has it done as much as it can now to help the Eurozone?
I think it has done all it can in the short term. Nonetheless, if things get completely out of whack, particularly in Spain or even in the worst case in Italy, in terms of bonds rising in the back end of the curve, then they may have to step in and try to calm things down. They've put a tremendous amount of money in the system, and they're waiting to see what the outcome of that money floating into the system will do. For now, it seems to be doing its job, which is basically stabilizing the financial system, stabilizing also bond yields and peripherals. But they don't exactly know, what's going to happen 2, 3, or 4, or 5, 6 months down the road. They're just going to watch it and see what happens. It doesn't mean that they can't do more. They certainly can if they want to. They are, in this sense, competing with the Fed and how dovish you can get, and they need to. So it's not over, but everybody's in the wait-and-see mode.
The news stream from Italy and in particular Spain has been growing increasingly negative over recent days and weeks. Is this going to be the big focus of market attention in the coming weeks and months?
It is a nice thematic. I think it's a cute story. If you read the IMF reports from the early 1990s and you read them now, there's basically no difference. If you read the analyst reports from 2006 and 2007 on Spain and you read them now, there is no major difference. We all know what the risks are. Some of these risks have been happening and have been rolling down. That's basically the housing market has been moving much lower. There's deleveraging of balance sheets and mostly linked to the fact that the tourism industry is collapsing to levels which are more sustainable. It is a nice, cute theme. People try to rotate their bearish themes on Europe. If it is Spain to be in the next few weeks, it might be Ireland next month. They are trying to find something new. The problem with the Eurozone is everybody knows what the problems are. All you see is basically some evidence either it's getting a little bit better or a little bit worse. People tend to like the little bit worse story because they think it can create contagion. It's not really working very well, but you should still watch out for the back end of the curve in Spain and as well as in Italy because, for example, if you reach certain levels, then it becomes unsustainable in the sense that we know that they can't sustain their fiscal targets. But I think the ECB will have stepped in before that happens. So yes, Spain matters. Yes, we like Spain if you want to be bearish. Does it truly matter? The answer is probably not. People's expectations regarding the Eurozone are pretty low. That is helping to pressure the euro-dollar lower. We don't think it's going to break 130 anytime soon, but in the many weeks to come, that will eventually happen.
So how do you expect the euro-dollar to move over the coming months? Do you expect it to maintain its position above 130?
Yes, we do. If you give a 1 month horizon, I think everybody gets overexcited and they go bearish on the euro. And the problem is we are in a range trading environment. That means people will try to hunt for positions. The problem with the euro dollar is most of the market is already short euro dollar, so there's only so much you can do over the short term on that story. So what it ultimately means is there will be a deep hesitation to break up below the 130 level. We also can count on the Fed to sound dovish if the euro dollar starts to collapse a little bit more because it means the dollar is rising relative to its major competitor. So it's a tug of war between the Fed and the ECB. I think the Fed should never be underestimated, and that means the euro dollar is probably in the short term somewhere in the 130, 135 ranges, and the possibility of a squeeze once we reach the 130 level and we move back to 132, 133 over the many weeks to come. And the odds are that the ECB has or the Eurozone has its own problem and suggests that the euro should steadily inch lower and break below the 130 level. U.S. is doing better, should continue to do better, and we've actually revised upwards our forecast in terms of GDP and pushed our forecast in terms of QE3, and that basically I think is in line with the rest of the market. It's great to be in the U.S. I live in New York, and you can see it's actually doing quite well. People are optimistic, and it's being reflected in the rest of the economy.
If we turn our attention to the Bank of England's meeting on Thursday, there is growing pressure for the Bank of England to increase QE further. Do you think we're likely to see this tomorrow or even further down the line?
I think in the short term, it's not really working out for that type of argumentation. I think the latest readings out of the UK are pretty darn strong. It may be the case that the Olympics effect is finally coming through. It may be also the impact of a weak sterling, which is also starting to filter through. I mean, manufacturing in the UK from a low base is actually continuously surprising us to the upside, which suggests the UK economy may be rebalancing. So that there's a lot of good stories in terms of the UK, and the sterling is rising relative to the euro, but only in a very slow process. And we are bullish on sterling versus the euro over the many months to come. We expect euro sterling to continue to break lower, even if it is happening at a very slow speed. So the QE story for the UK, it may eventually come through. It doesn't really have much of an impact because yields are so low in the UK that really makes very little difference. Housing market is starting to recover. So, it's all good. The machine, the leverage machine is back in action in the UK. Every foreigner on earth wants to buy an apartment, in Hampstead and other places in London. And that is helping the UK economy to continue to do what it does best, which is basically, peter around and start to outperform in the Eurozone.
Okay, thank you as always, Sebastien. We have more interviews to come here on Dukascopy TV, including the build-up to NFP Friday. But for now, goodbye.